It is darkest before the dawn, and the best time to invest, according to Warren Buffett and the great investors of our time and of all time, is when there is so-called blood in the street. It's a crude saying, but it means when markets are deeply into bear territory. You should have, there's a cycle of fear and greed, and both are healthy. The fear should occur at the top of cycles, taking profits, and the so-called greed part of that dynamic.
Cathie Wood and her team at ARK Invest have been on a tear this year. This comes with questions about the sustainability of sky-high stock performance and questions regarding her marketing outlook for 2023. The ARK investment manager, Cathie Wood, said the bond market appears to show that the Federal Reserve is making a serious mistake with its monetary policy. Deflation is a much bigger risk than inflation, Wood said in a series of interviews, adding that commodity prices and massive retail discounts were underscoring her view. Wood also discussed how, from a fundamental perspective, from explosive profit expectations this year to Fed policy to stimulus that's more than plenty to copper, she sees healthy equity growth ahead. Except that the good news doesn't apply to all stocks in the post-pandemic world. With a cultural trend acceleration that's converged with exponential profit growth unlocked by the latest disruptive innovations, it's sink or swims out there right now. Within the equity market, we do believe there's a bifurcation developing. We think it will be impacting stock prices in a much more intense way going forward, between those companies that are on the leading edge of innovation versus those companies that have not been doing that, she warned. Wood said cash levels are at their highest point since the 9/11 crisis in 2001. Investors are also overweight in bonds for the first time since April 2009, suggesting that risk appetite has changed during the high inflation period. The put-or-call ratio also hits highest level on record, passing the multiple seen during the tech and telecom bubble and the 2008 global financial crisis, Wood added. In hindsight, both of those times were terrific opportunities to put funds to work in highly differentiated ways. To the extent investors have reserves of cash to put to work, ARK believes that this time will be no different and that innovation strategies will be prime beneficiaries when equity markets recover. Let's listen to Cathie Wood as she discusses the Fed policy, how it impacts the market, the current state of the market, and the innovations expected in the coming years. As you watch the video, endeavor to hit the like button, subscribe, and drop your comments as you go.
Our market outlook for 2023, inflation, interest rates, corporate earnings, and how innovation should fare in that environment. Okay, well, we know that we're getting a lot of deflationary signals, but the Fed isn't really buying into that yet. We think that the bond market, though, will start to convince the Fed. So the bond market is telegraphing either much lower than inflation, lower than expected inflation, or recession, or both. And we've seen the 10-year Treasury bond yield drop from 4.25 to 3. It got down to 3.45. It's around 3.6 right now. So that doesn't leave very much room. If you assume that the long bond is kind of a proxy for how fast nominal GDP will grow, it doesn't leave enough room for much growth and inflation. And we also know that the market always leads the Fed. And I think the bond market is speaking very loudly. Jeff Gundlach, very interestingly, Double Line's famous bond investor, very, very successful. He has made the point, okay, it does look like inflation's coming down. Why is it going to stop at 2%? And we would agree with that. We're seeing a lot of deflation in the pipeline. Commodity prices, discounts at retail during the holiday season to clean the shelves of massive inventories. So we think that's going to show through in terms of inflation. And very importantly, housing has taken it on the chin this year. Usually the Fed is very sensitive to that. Autos as well. They really went nowhere, and now used car pricing is down 14% on a year-over-year basis. So inflation will come down, and innovation actually is going to be part of that equation. The truly disruptive innovation platforms around which we have centered our research, so gene sequencing, robotics, energy storage, artificial intelligence, and especially artificial intelligence, as well as blockchain technology. All of them are deflationary in nature. Good deflation, it should cause a boom in the products and services associated with innovation. But deflation, another source of deflation. So our confidence there is building. We've been right on the inventory build, the commodity price decline. And I think normally the market would have responded already. The market is waiting for the Fed. And we think the Fed's rhetoric will change first, and then its actions will change. And we think that's all going to take place in 2023. Investors seem hesitant to invest now for long-term growth, given supply chain disruptions and the economic downturn caused by rising interest rates. Why do we believe that now is a once-in-a-century investment opportunity? Well, a couple of reasons. Innovation solves problems. And we have a lot more problems now, even more than during COVID. We have corporations now experiencing margin pressure. And we have individuals, consumers, perhaps worrying about their jobs. And when we get into a period like this, businesses and consumers are willing to change the way they do things. And they embrace innovative solutions to their problems. Now, this once in a century is not an understatement. We have not seen more innovation platforms evolve at the same time ever. The closest is about 100 years ago: telephone, electricity, and automobile. Interestingly, back then, we were just getting over a pandemic, the Spanish flu, and over a war, World War I. And at the same time, we were experiencing incredible innovation. And so very similar dynamics. And what happened? Inflation peaked in June of 1920 at 24%. And within 1 year, it was minus 15%. We think we're going to experience a mini version of that during the next year. And then what happened? We launched into the roaring 20s when the stock market had, I believe it was a compound annual rate of returns of 25% for the next 8 years. The roaring 20s, we think we have a setup here for the roaring 20s, and it is all around innovation.
Cathie's ARK Invest believes that 5 innovation platforms, DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technologies, which involve 14 different technologies, will lead the way to exponential growth in the next 5 to 10 years. They are going to be the big winners, and they are going to create a lot of losers out there. Wood said the firm will continue to invest in companies that have technologies that can change the world, including early-stage cancer screening tests, artificial intelligence, and rocket launch companies. Wood said the current economy echoes 1920 when World War I and the Spanish flu, and the associated supply chain snarls, pushed inflation above 20%, only to have it drop dramatically the following year. The Federal Reserve, which lowered interest rates at the time, helped usher in the era known as the Roaring Twenties, or a decade of economic growth. A decade later, amid warnings of overspeculation in the stock market, the Fed increased interest rates. The Great Crash was then followed by the Great Depression. Wood urged the Fed to pivot from its current rate hike cycle, saying the economy is showing signs of reducing inflationary pressures. We would not be surprised to see broad-based inflation turn negative in 2023, she said. What do you think of Wood's market outlook for the year and speculations for the coming year? Let us know what you think in the comments section. Also, sure to like the video, subscribe, and turn on notifications. Thanks for watching.